and welcome to the Affle 3i Limited Q4 and 12-month FY 2026 earnings conference call hosted by Ambit Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ashwin Mehta from Ambit Capital. Thank you, and over to you, sir.
Thank you, Ikra. Good morning, everyone. On behalf of Ambit Capital, we welcome you all to the Q4 and 12-month FY26 conference call of Affle 3i Limited. I take this opportunity to welcome the management of Affle 3i Limited, represented by Mr. Anuj Khanna Soham, who is Chairperson, MD and CEO of the company, and Mr. Kapil Bhutani, who is the Chief Financial and Operations Officer of the company. Before we begin with the discussion, I would like to remind you that some of the statements made in today's conference call may be forward-looking in nature and may involve some risks and uncertainties. Kindly refer to the slide 2 of the company's earnings presentation for a detailed disclaimer. I will hand over the call to Mr. Anuj Khanna Soham for his opening remarks. Thanks, and over to you, Anuj.
Thank you. Good morning, everyone, and thank you for joining the call today. I trust all of you are keeping in good health. Affle's growth story is of consistent compounding for the last 5 years. We have delivered on our medium-term guidance across both top line and profitability on the back of our robust AI-powered consumer platform stack. FY 2026 has been a strong foundational year in our 3i journey as the first full year of our third decade as Affle 3i Limited. We have advanced our vision with disciplined execution and clear strategic intent. We are firmly on course to deliver on our medium-term guidance of 20% CAGR as we progress towards our 10x decadal growth vision. We concluded another year on a remarkable note, registering our 13th consecutive quarter of sequential top-line growth, despite a challenging macro environment. In Q4 FY 2026, we delivered revenue of INR 7.24 billion, an increase of 20.3% year-on-year, sustaining the growth momentum that has defined Affle's trajectory over the past years. Our continued focus on improving operational efficiency and productivity translated into EBITDA of INR 1.61 billion, growing over 20.3% year-on-year. PAT stood at INR 1.2 billion, increasing by 16% year-on-year, with the growth remaining relatively subdued given our lower effective tax rate in the base quarter last year. Our profit before tax from operations, excluding other income, grew in line with EBITDA at 20.8%. Our CPCU business continued to scale, delivering 120.3 million conversions at a CPCU rate of INR 60, translating into CPCU revenues of INR 7.21 billion. Our growth has been consistently broad-based across key industry verticals and geographies. India and global emerging markets together contributed 71.6% of our revenues, while growing by 21.2% year-on-year. Our developed markets delivered a resilient performance, growing 18% year-on-year, and contributed 28.4% of our revenues in Q4 FY 2026. This growth was achieved despite some temporary softness in select markets and verticals during the quarter due to the geopolitical events. However, our growth was driven by disciplined sales efforts, deeper customer engagements, and new logo additions.
Ladies and gentlemen, the line for the management has been disconnected. Please stay connected while we get them back. Ladies and gentlemen, thank you for being on hold. The management has been reconnected. Thank you and over to you, sir.
My sincere apologies for the disconnection and the disruption. I will restart from, I believe the last line that was heard was that our CPCU revenue of INR 7.21 billion was achieved. Our growth has been consistently broad-based across key industry verticals and geographies. India and global emerging markets together contributed 71.6% of our revenues, while growing by 21.2% year-on-year. Our developed markets delivered a resilient performance, growing 18% year-on-year, and contributed 28.4% of our revenues in Q4 FY26. This growth was achieved despite some temporary softness in select markets and verticals during the quarter due to the geopolitical events. However, our growth was driven by disciplined sales efforts, deeper customer engagements, and new logo additions. We continue to unlock new avenues for growth, further strengthening our position as a trusted, privacy-compliant, and results-driven platform. For the full year, we delivered revenues of INR 27.1 billion, a growth of 19.5% year-on-year, with EBITDA of INR 6.1 billion at a robust growth of 26.3% year-on-year, and PAT of INR 4.55 billion, growing 19.1% year-on-year. These outcomes are underpinned by our continued investments in AI and platform innovations, enhancing campaign effectiveness, conversion quality, and operating efficiency. During the year, we further augmented our capabilities through the integration of Optics AI, Nico, into our consumer platform stack, driving improvements in creative optimization and automated campaign management. We are deepening our AI-native capabilities across the organization with focused efforts on upskilling our teams and embedding AI into day-to-day workflows, enabling higher productivity and more effective execution. This quarter, we have also featured 3 customer-approved case studies across key industry verticals in earnings presentation. The first case study highlights our capabilities in driving high-value iOS shoppers conversions for a quick commerce player in the US, leveraging our ability to target high lifetime value users at key intent moments to drive first-time purchases. The second case study focuses on driving existing gamers conversions for a global gaming advertiser, where we boosted repeated conversions and ROI through AI-driven audience modeling and interactive creatives. The third case study highlights our ability to scale new user conversions and maximizing ROI for an Indian fintech customer, leveraging on-device in-app premium placements through our AI-powered intent and recommendation engine and dynamic creative optimization. Affle continues to be recognized as a technology thought leader across industry forums. Our platforms have ranked amongst the top ROI-driving AI ad partners and growth leaders globally in the Singular ROI Index 2026, earning several other placements across various categories. We also received several accolades across leading industry forums during the year, notably the Best MarTech Platform of the Year, along with 5 other accolades at the DigiXX Summit and Awards 2026. Most Effective Tech Platform at the Maddies, and wins across categories in the 16th India Digital Awards. We continued our efforts to take stronger strides in ring-fencing our technology moat. We received 5 new patent grants during the year, taking our comprehensive IP portfolio to 18 unique patents granted, 21 filed and pending. With over or around 300 unique enforceable patent claims, our patents span across fraud intelligence, human versus non-human distillation, precision targeting, contextual and gesture-based advertising, and next-generation AI-native ads and engagements across key industry verticals. The breadth and depth of this position or portfolio of our IP is unique and defensible. From the standpoint and the vantage point of the digital advertising, can you still hear me well?
Yes, sir, we can hear you.
Thank you. The breadth and depth of this position with the unique and defensible IP ensures that when the digital ecosystem continues to evolve, and it is evolving rapidly, we have been future-proofing our business for the next phase of digital advertising growth. As we look forward, the structural tailwinds of our efforts in FY 2026 are compelling. We see global ad spends rising, with AI expanding the frontiers of ROI-based, returns-based advertising in ways that will fundamentally reshape how brands engage and convert consumers. These are structural shifts that play directly to Affle's core strengths. Our first-party data intelligence algorithms, unique IP on ads and audience intelligence, and our deeply verticalized approach across key industry verticals and geographies collectively positions us to capture a disproportionate share of this growing opportunity. We are future-ready, and we remain agile and steadfast in our commitment to delivering sustainable, profitable growth and creating enduring value for all our stakeholders. Lastly, on inorganic efforts, we continue to actively pursue growth opportunities that are strategically aligned with our 3I vision. To further bolster our readiness in closing the deals, our board has approved a preferential issue of equity shares to strengthen our balance sheet. Post our shareholders' approval, our corporate promoter, Affle Holdings, will invest to acquire 7.4 million warrants at INR 1,487, totaling to approximately INR 11 billion, with 25% upfront payment. This will ensure that we are well capitalized and ready to move swiftly this year on the right acquisition opportunities. This is a proactive step towards executing our inorganic growth strategy with the calibrated discipline and conviction that has defined our organic growth journey. With that, I now hand over the call and discussion to our CFO, Kapil Bhutani, to discuss the financials. Thank you, and over to you, Kapil.
Thank you, Manoj. Wishing everybody a good day and hope all of you are still keeping safe and well. As we turn the page from financial year 2026 to financial year 2027, in Affle's consistent growth story, we do so with a greater conviction, concluding FY26 on a stronger note. For the full year, on consolidated basis, we achieved revenue of 27.09 billion, representing 19.5% year-on-year increase, as our unique ROI-linked CPC business model continues to be in a high growth momentum. Our sustained focus on operational efficiency and profitable growth translated into EBITDA of INR 6.10 billion for the full year, registering a robust 26.3% year-on-year growth with a margin of 22.5% on an improvement of 120 basis points year-on-year. We achieved operating cash flows of INR 5.02 billion during the year, increasing by 25% CAGR over the last 5 years. This underscores the quality of our earnings, our disciplined working capital management, our consistent ability to convert profitable growth into strong cash flows. Our PAT for the year stood at INR 4.5 billion, an increase of 19.1% year-on-year, with a PAT margin expanding to 16.3% versus 16.2% in financial year 2025, despite lower other income during the year. Our profit before tax from operations, excluding other income, stood at INR 4.80 billion for the year, growing 28.5% year-on-year, outpacing our EBITDA growth, and reflecting an underlying strength of our core business from operations. Now, coming to quarter 4 for financial year 2026, there were some macro challenges due to geopolitical events which required recalibration. Despite this, we achieved our 13th consecutive quarter-on-quarter top-line growth. On the consolidated basis for the quarter, the revenue stood at INR 7.24 billion, registering a year-on-year growth of 20.3% and a sequential growth of 1%. We were able to sustain balanced growth across India and international markets. On an adjusted basis, our India revenue grew by 19.5% year-on-year, developed market increased by 18% year-on-year, and emerging market registered a robust growth of 22.3% year-on-year. We recorded EBITDA of INR 1.61 billion for the quarter, registering a growth of 20.3% year-on-year. Our EBITDA margin stood at 22.3%, broadly in line with Q4 last year. In terms of OPEX, our inventory and data costs stood at 63.3% of the revenues for the quarter, an increase of approximately 90 basis points sequentially. Our employee benefit expenses remain largely flat as we continue to leverage our ongoing investment in AI and innovation, driving greater productivity across teams and operations. Our other expenses declined by 4.3% sequentially, reflecting a natural moderation in business promotion equity following a sequentially active quarter three. We achieved a profit before tax of INR 1.4 billion during the quarter, an increase of 19.5% year-on-year and 1.3% quarter-on-quarter. Our profit after tax stood at INR 1.2 billion, marking an increase of 16% year-on-year and 0.2% on quarter-on-quarter basis. The PAT growth in percentage terms is subdued on account of lower tax rate in quarter four last year. However, on a full year basis, our ETR was in line at 18.6% versus 18.3% last year. We continue to prioritize efficient working capital management, and as such, there were no material changes in collection risk during the quarter. Building on the 5-year consistent and profitable growth, we remain confident and resilient of resilience of our business model and strength of our AI-powered consumer platform stack to sustain this momentum through FY27 and beyond. Even as the global environment continues to present new challenges and opportunities in equal measure, our disciplined financial management, supported by healthy balance sheet and robust operating cash flows, provide strong foundation to capture emerging opportunities ahead. With this, I end our presentation. Let us please open the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ashwin Mehta from Ambit Capital. Please go ahead.
Yeah, thanks for the opportunity. So I think one question in terms of how is the competitive dynamics evolving in the GenAI era, especially from walled gardens as well as the GenAI natives. And while we've talked about on the creative side, the Optics AI platform helping us, but on the campaign management and the targeting side, how are things changing versus earlier? And what are our priorities in terms of investments there?
Thanks, Ashwin. Regarding the competitor ecosystem evolving, there's not no significant change. I think all of the competitors are, responding towards AI in their own sort of initiatives and ways, and largely trying to do what is appropriate and obvious at the moment. I would say that the competitive edge that Affle has versus, let's say, most of the other competitors is that we are working with the advertisers directly. We are integrating, as part of our CPC unique business model, deeper conversion level first-party data integrations with our advertisers directly. And I think that makes us a very unique position. What also is different and unique about us is the fact that we are across all the top key industry verticals, and our platform is being verticalized deeply first integrated with the advertisers across those unique verticals. So it's not just like a horizontal solution. We are very focused on those industry verticals, and our premium sort of positioning for that, and even our, let's say, AI algorithms or AI-related experience are deeply verticalized for those industry verticals. So that gives us another sort of differentiation and edge. In terms of how we are performing versus the competition, I find that across e-commerce, entertainment, fintech, food tech, and now increasingly also in healthcare, we are seeing some real competitive advantages of our, verticalized approach and direct-to-advertisers approach. It'll be hard for competitors to respond to that because a lot of them are not on CPCU business model, as you already know, and a lot of them are also not directly, deeply integrated with the advertisers' first-party data. So I think that makes a big difference. In terms of the walled gardens, I would say on AI side, the automation tools that the walled gardens are providing, I think that's definitely helping them. You can see it from the results. And that's across the board trend that we would see that, in ad tech, AI will be a clear tailwind, whether it is the walled gardens, whether it is Apple, whether it is the other competitors. Then the main question is that who will capture more of this, increasingly expanded AI-oriented digital ecosystem. And I think on that, our approach is very clear. Direct to advertisers, first-party integration, CPCU business model, and deep verticalization to ensure that there's a premium, integration that is provided that's not easily comparable or replaceable with any other competitor. So that's how I would look at the competitive landscape. In terms of our own, technology evolution with Optics AI, Nico AI, we are seeing adoption across our customers, and there's clearly seeing value addition happening both on the iOS side of things and Android ecosystem. We're also seeing it going beyond mobile to CTV, and we are seeing very, very good impact overall of how AI is being implemented. One very key differentiation that I would like to highlight for everybody's benefit is that as more and more agentic AI, tools come around the internet across, industries, across different business cases, and even as more and more consumers start having more and more agentic AI, what's going to be super important in digital advertising is what we define as human versus non-human filtration. It has to be very clear to our advertisers, and technology platforms have a duty to show that, hey, if we are showing an ad, we are actually able to filter out whether this was a human engagement or whether this was an agentic or non-human engagement. You would notice that Apple has been talking about this ever since, pre-IPO days of 2017, when we filed several patents to distinguish between human versus machine activity. And this is an area where we've got several patents granted over many years. And this time, with the advent of agentic AI and the, let's say, explosion of AI-generated apps or contents in the internet, this particular intellectual property or, proposition or capability of Apple's 3i consumer platform stack is becoming an outstanding differentiator as we talk to the advertisers, right? So how do we filter out human versus non-human traffic? And this problem statement is something that Apple has got some unique moats around it. And I think the competitors are not responding to this bit as much. So all the competitors, wherever you hear AI is about automation or generating, content, but very few people are talking about technology where they can filter out whether this is an engagement from a human or a non-human. And I think this is an area where Affle is very differentiated.
So just one follow-up to this. So you talked about filtering the human versus non-human traffic. But in terms of targeting the non-human traffic for conversions, how would things work differently versus how they have been when we are targeting humans?
So, you see, when an advertiser would spend budgets, let's talk 5 years from now. I mean, today I think it's still very early, and, agentic will evolve over the next 5 years. The advertisers would most certainly want to make sure that a big part of their budget is spent to actually deliver on human engagements and driving conversions directly with humans. And there would be a smaller part of the budget that they would also say that, okay, use that to influence authentic AI agents that are acting on behalf of the humans, or the consumers. There will always be this bigger challenge. Okay, so let's put it into 3 buckets. A big part of the ad spend will go to target humans. We are addressing that very well. Another smaller part, but a meaningful part, could go towards targeting the AI agents, which are authenticated and are, let's say, assisting the humans or the consumers. And we must absolutely ensure that there is no loss of budget or engagement to the noisy, authenticated AI agents. There will be tons of those which are pretending to be Ashwin or Anuj or, and are what we call as digital fraud, right? So there will be a huge need for filtering that out while clearly having this technology differentiation that we have and the IP that we have evolving for the next competitive moat and we are ahead of the curve versus what most of the competitors are talking or demonstrating in their roadmaps at the moment.
Thanks, Anuj. Thanks for the answers. Ikra, you can take the next question.
Thank you. Next question is from the line of Arun Prasad from Avendus Spark. Please go ahead.
Good morning. Thanks for the opportunity. Anuj, my first question is on gross margins. If you see last 7-8 quarters, we are continuously seeing a reduction in the margins from a percentage perspective. While I see positive in this because we are able to deliver absolute growth in both gross margins and EBITDA margins. My question is that this gross margin reduction, is it because we are responding to the competition, or is it because of the vertical mix change, or is it the conscious decision? And if it is a conscious decision, how much of this you would say that it has contributed to our growth, and where this leads to in terms of future? In future, there is only limited way you can do this. Your thoughts on this, please.
Thanks. No, I think we are very range bound. I think within our unit economic model, we are very disciplined in how we execute this. So you will have, first of all, no investor should see any particular surprises in terms of how we execute. We should be very predictable, dependable in terms of how we continue to grow our CPCU pricing, how we continue to grow our overall volumes of conversions, and keep the data inventory cost at a sensible level and a calibrated level. So this is an overall, long-term view that I can give to you. In the short term, in the, let's say, last several quarters, you would see that we have been calibrating and investing towards launching more verticals in more geographies, going deeper in our verticalization approach direct to advertisers, and also emphasizing on premium positioning for the Affle platform. Why is it a premium? Because it is targeting higher value lifetime users. To get to those higher value lifetime users, you have to target premium device models, premium touch points on those device models. You've got to go to CTV, you've got to go to, more, let's say, you have to find the high lifetime value users for the advertisers. That involves deeper investments, and I use the word investment, not expense, but accounting wise, of course, everything is expensed out in data inventory cost. Deeper investment to build audience intelligence and advertiser intelligence that is verticalized and highly integrated with the first party data intelligence of our platforms. And I think this area of investment has been a conscious decision. Having said that, it doesn't take away from the overall sensibility of our unit economic model. And therefore, you've seen overall expansion and growth in a sensible manner. So it should stay range bound. And there's still a long runway for growth, delivering 20% plus growth over the next 5 years is our goal. And therefore, verticalization, going towards the premium positioning, more first-party data integrations, and these areas of investments across developed markets where we are clearly undercalibrated at the moment. There's a long runway for growth. So we are investing in that area, and that's what you're seeing in terms of the margin profile. But, over a period of time, we would think that even this particular aspect would lead to further improvement, and we should see better margins and, even more stronger bottom line performance.
Understood. So one clarification on this. Say the 39% to 36.5 to 250 bits reduction in the gross margin. Largely, if it can be attributed to the investments, how long does it take to these investments to pay off? I mean, how long we can get back to say 38%, 37%, 38% kind of margins? Is there any timeline you are operating with, or it's just still early days?
I think about a year, we should be able to achieve the level of verticalization and the level of intel that we need to develop across, all the key geographies. And hopefully around that time onwards, we should see another year of bringing it back to, better levels of, where we don't need to invest as much. Yeah.
Understood. My second question is on AI. In the era of abundant intelligence and inexpensive intelligence, there are two things one can happen. One, what we have built over say last several years or almost a decade, someone with a really resourceful competition can probably build it in a shorter period of time. So either it can lead to consolidation, or it can encourage new players. How do you see this playing out in at least in the medium term? Do you see first consolidation and then the new players, or to first encourage new players, which will lead to a consolidation later?
So, first of all, it's, we are a very strong business-to-business platform, right? We are deeply integrated with the advertisers whose, data integrations and apps integrations is a non-trivial matter. To do it across industry verticals, across geographies with our very broad-based and diversified presence takes a lot of time. It's not as simple as, okay, let's launch an AI model and we're done. So you need to go and do the contracts with these advertisers across all these central verticals, across geographies, integrate the apps and the data layers, and then you can start training an AI model on that. This is not something that's readily available, that you go on the internet and you crawl around and you build intelligence. This is not the kind of intelligence we are talking about. The kind of audience intelligence and the advertiser intelligence we are talking about is deeply verticalized, and this intel requires, a fairly long execution period to get through. So for new entrants, it's going to be really hard. For the existing incumbent players, they will have to compete with Affle to get to that depth of verticalized data integration and processing and intel to go on a CPCU business model from where they are today, which is still very much on impressions and clicks. So changing your business model, changing the technology stack, going and convincing advertisers for a deeper integration. Let's take an example. Let's say a company like Trade Desk, which is doing, it's a demand-side platform focused on, serving ad agencies as partners. So the transition, and they're not necessarily, focused on, nor talking about, nor investing at the moment on the CPCU business model. So for them to, let's say, start transitioning to CPCU business model, going direct to advertisers, integrating deeply on the first-party data of the apps of the advertisers, it's going to be a massive transition. So incumbent organizations will find it challenging, and new entrants would also find it challenging. So I wouldn't say that it is low-cost AI. It is deep, verticalized, premium advertiser and audience intel, which is not readily available, where you can't just say, okay, I've taken a cloud connection, internet, and now I've become intelligent. It doesn't work like that.
Thank you. Next question is from the line of Vijit Jain from Citigroup. Please go ahead.
Yeah, hi, thanks for the opportunity. I have two questions. One, with this fundraise that you've announced, and I know in the past you've said that you look at the trailing 12 months operating profit as a benchmark or something for an M&A activity. So my question first is, are we looking at somewhere around $200 million is the ticket size? I understand it can go up and down, but is that the general ballpark? And related question, have you kind of narrowed focus on the kind of asset you want to acquire there as well? That's my first question, and then I'll come back with the second.
I would give the answer to the second question first, because in the last earnings call also I had mentioned that, we have evaluated several companies, more than 10, and then we've shortlisted about 4, where we are doing deeper due diligence, we are doing deeper assessments as well as negotiations. I wouldn't want to give any color to the size of the transaction, because there are a few transactions that we're talking about, very, very small transactions. I don't want to confuse your analysis on that. There are some larger ones. So there's small, mid-sized, and larger ones, and we may do more than one in terms of how we execute through the rest of this financial year. So I would say stay tuned. As and when we are closer to and have a definite announcement on it, we will be very proactive in explaining our approach and strategy. But it is important to also note that given the ambition of the organization and the kind of shortlisted pipeline of the opportunities that we are actively engaged with, it is now prudent, it is now the right time for the company to be ready with the necessary capital and seriousness to send the right message even to the boards of the selling organizations to know that we are serious, we are here, and that we have the necessary financial resources to execute in the very short term if it is needed. But we will, like I said, we will take our own time. There's no pressure to act like today or tomorrow, but we are, making sure that we execute at the right terms, at the right price, with the right target company. So we will be very patient, very calibrated, and we will bring the right transaction to unlock value for our shareholders.
Got it. Understood. That's very helpful. Thank you. My second question is, in your earlier remarks, Anuj, you said a couple of times that in this next phase of growth in AI, advertising, it'll be direct to advertisers and first-party data integration and so on. And I know that there's been some recent tensions between ad agencies and some, not you guys, but some other DSPs as well. So is that a nod to that? Do you see the whole structure of industry kind of changing post AI? Is that a nod to that? And related question to that, I suppose, is if you can give me a color on what your current footprint is of in terms of your active SDK integrations that you have with publishers and how that has trended over the last one.
Right. So maybe what I can tell you is that in terms of the industry trend, all I'm saying is that you have to be closer to your customer. And if you look at our earnings slide, there's one particular slide that gives the entire Affle 3i consumer platform stack details. One slide that tells you how we are direct to advertiser by design, and there we call AI as advertiser intelligence. And not just that, we call it verticalized AI, which is verticalized advertiser intelligence. And then on the other side, we're talking about AI as an audience intelligence, where we have 4 billion consumer devices that we are able to reach out, and therefore we are profiling or processing audience intelligence at scale. And that is highly personalized to deliver personalized recommendation. There's vernacular intel, creative optimization, all of those things. The kind of scale and premium verticalization that we're talking about, this is the model that we're talking about. We are saying this is what we believe in. Now, there are a few pathways to go to the advertiser, and for us, 75% of our pathway is direct with the advertiser. There is no other company involved in between. 25% plus of the revenue is through large ad agency group partners, but even there, our tech stack is directly integrated with the end advertiser's app, because we are driving CPCU business model. So our business model requires that even if there is an agency or a partner in between, we would still need to integrate with the end advertiser directly. It's a necessary requirement. That's what I'm emphasizing about. I think the role of ad agencies, will continue to be relevant. It will change. It will evolve. It will become, a lot more efficient, or perhaps even higher value roles and functions that they could play. So I wouldn't really opine on their future, but all I'm saying is that for a tech stack like ours, we need to connect and be deeply integrated with the advertiser. So that's the main emphasis point there. In terms of the SDK footprint, our direct to consumer conversions approach of the business allows us several pathways of working. So on that slide, you would see the supply side integrations, the OEM and operator integrations, there is even walled gardens integrations, and we are working on the mobile device, we are working on the CTV devices, the connected household devices, and also on digital out of home. I mean, of course, that's a very small part of our sort of business, but we are looking at the consumer journey as an end-to-end connected journey. We work with a lot of the SDK partners as well. Our own SDK is also doing well. And, one of the areas of the footprint expansion is that, going deeper with those publishers, because once you have the kind of advertiser demand that we command in the market today with the verticalized integrations, that is unique advertisers' demand. So all the publisher side of the ecosystem, we are able to absolutely work with and, find deep next with. So maybe I'll just leave it at that, but the footprint is expanding. Today, our footprint, not of the SDK alone, but across all the channels that we have to reach out to the consumer conversions directly, has over 4 billion connected devices footprint, and that's not insignificant.
Understood, Anuj. And if I can just follow up.
I'm sorry to interrupt, Mr. Jain.
This was just a follow-up, but yeah, sure.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all the participants in the conference, kindly limit your questions to 2 per participant. Should you have a follow-up question, please rejoin. The next question is from the line of Adil Khan from ICICI Prudential Life Insurance. Please go ahead.
Yeah, hi, sir. Congratulations on a great set of numbers. I have a couple of questions. So firstly, when it comes to acquisition, like you mentioned that, you've gone down to 4 entities. So what kind of capabilities are we looking for in these companies? And secondly, if you could give us a timeline.
Thanks, Adil, for your question. In terms of capabilities, our focus is to, take on direct access to a lot more advertisers and, sales force out there with certain levels of initial integrations that they may have already done with those customers and advertisers in developed markets or even globally. And then we were assessing them whether those integrations and relationships can be tapped on by Affle to really bring a transformative life to our strategy to go and take that acquired company and make it the verticalized first-party data integrated direct-to-advertiser platform that we're talking about here. So again, the target is to get to a larger base of customers and have a sales team with ready relationships, have a tech stack with some ready integrations, and then to transform it and enhance it to the playbook of Affle, which is to make it a much more premium platform versus the way it is operating at the moment, and to enhance its competitive mode using Affle's approach and strategy as well as our technology. So that's what we're looking at. The goal is to strengthen ourselves even more in developed markets and be much more verticalized, both with the advertiser verticals as well as at an ecosystem level, right from the advertiser to the consumer platform, the consumer conversions. How can we go, fully simplifying and unifying the ecosystem from the advertisers to consumer conversions? And that's our strategy and approach. In terms of the timeline, I think we are working. There's a realistic chance that we may, conclude a meaningfully sized transaction within this year itself. And I say year, I'm not meaning the whole financial year, but within this calendar year. And these transactions do take time because, we're talking about, the full due diligence process, the negotiation, the conclusion of the governance processes around it. And once we are closer to the definitive agreements and dates, we will certainly provide the clearer timeline. But for now, I think it should be, reasonable to say that within this year, calendar year, we should see a transaction hopefully of a meaningful size.
Perfect, sir. Thank you so much.
Thank you. Next question is from the line of Divyesh Mehta from Invesco India. Please go ahead.
So with respect to the gross margins, what the investment we are doing, can you give some context as to how much more investments are pending? And when should we expect these investments to taper off? That's the first question. Second one is, given how the market is shifting within AdTech, do you think this is the right time to enter into the SSP space in a meaningful way? That's it.
Thanks for your questions. I think I've already given some guidance on this answer on gross margins, that we are investing with a very clear, purpose-driven, strategy, which is to be deeply verticalized, be a premium platform that has intelligence across key geographic regions and key industry verticals. And that requires the right kind of investment. Going to lifetime value, high lifetime value consumer conversions, that kind of a premium positioning requires certain investment and intelligence building, and we are doing that really well at scale. Now, I did mention that it will take about a year more, and then we will start seeing greater benefits of that in the second year and hopefully improving the margin percentages in the financials progressively. With respect to your second question regarding SSPs, our view is very straightforward. We see, these terminologies where, an organization is just playing on the SSP side, or companies that are only playing on the SSP side. For those who don't understand this terminology, there are companies that only focus on the supply side. My opinion is not very strongly in favor of that. My view is that anybody who's in, let's say, provision of technology for advertising has to find a way to be very close to the advertiser, very close to the customer, going for deeper integrations with the advertisers and the customers in order to ensure that you can serve their interests well. And you have to have a direct-to-consumer conversions business model in order to absolutely, ensure that you're delivering ROI to the advertiser versus just playing a very point solution at one end of the ecosystem, saying only supply side. I think those platforms will be commoditized and it will be very, very hard for them to compete in the market. So even if we do any acquisitions, our strategy is very clear. We are looking for, finding a larger customer base, a larger sales force that can serve that customer base, and a tech stack that already has some preliminary integrations. And then how can we expand that into our, overall premium philosophy and transformation towards a verticalized, integrated platform, going direct to advertisers, direct to consumer conversion. And therefore, our play as Affle is always going to be an end-to-end platform. You will never see us gravitate, as a point solution on one side of the ecosystem, distant from the end customer who's paying, which is the advertiser.
That's helpful. Thanks.
Thank you. Next question is from the line of Anmol Garg from DAM Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. Couple of things that I wanted to understand. One thing is that I wanted to understand is that in case we acquire something, can we look to operate at different model like cost per impression or cost per click, or would we want to convert that company to the CPCU model itself?
Our endeavor would be to convert and transform over a period of time, but not doing it in an abnormal or not in the natural course of business. So, if you notice that in our previous acquisitions that we did in year 2020 to 2023, we acquired companies that were not naturally on a CPCU business model. They were not even on a unit economic model. They were not profitable. They were just barely breaking even. And we have transformed all of those business into, now a CPCU business model, but it takes time. It takes effort. Our goal would be to make sure that when we acquire, first of all, any business that we acquire, the valuation and the financial sensibility has to be very, very conservative, very, very prudent. We are putting our hard-earned money into, instead of building, we are making a decision to buy. So we will be very sensible, value-driven, and conservative in terms of the valuation. In terms of what we acquire, it should give us a clear and a meaningful starting point, a bigger base as a starting point, on which we can then ensure that we can grow the Affle's CPCU business and platforms on that base in those markets. So let's say we do an acquisition and, that target entity has a base of customers, a sales team, let's say in developed markets, North America and Europe. And soon after that, we will train those sales teams to take, our products and propositions on top of that to upsell, to cross-sell those deeper CPCU conversion use cases to those customers. And naturally, over a period of time, we would see, hopefully, that their own, the acquired business as we had it before, over the first year, second year, possibly by the third year, would be fully transformed to the CPCU or more premium positioning that we have with the advertisers.
Very helpful, Anuj. And in continuation to this, we have spoken about that CTV is a clear growth area into the industry. So just wanted to understand how CPCU model will work in the CTV type of engagement, or largely that would work on an impression kind of a model.
So the CPC model can work on, CTV engagement, it can work on digital out-of-home engagement, can work on mobile. And I think the answer is very simple. If you have the intention to deliver ROI all it requires is to back that intention with execution action to go deeply integrate with the advertiser. So, for example, if somebody sees an ad on the CTV and that person, let's say, engages with that ad in many different ways that can be done. We have a lot of unique ways that can be done. For example, you have your mobile phone. You can straight away scan a QR code, or maybe not even that. There could be some other ways. You look at the mobile phone, it can create some complementing experiences on it, and we can create re-engagement and repeat conversion possibilities on the mobile device. And the user is out there at digital out of home in a shopping mall or something like that. We can again create those kind of engagements that can drive either on your mobile device, straight away you go and you can do a conversion or a transaction with the advertiser's app, or in a physical mall situation, you can actually have a footfall driven there. Now to do the, let's say, conversion related business model, the fundamental insight is that the conversion has to happen inside the advertiser's environment, right? So whether it is the advertiser's app, or whether it is the advertiser's storefront, or whether it is the physical storefront, these are the places where the conversion event would happen. And therefore, Affle has to have deep first-party data integration with the advertisers to ensure that we are achieving that. And that's how we do it. CTV is an important part of the journey. What we have to think about it is not the screen. We are a consumer platform, and consumer platform, the consumer is on multiple screen touch points. In-app mobile, this is a very big and a very important touch point for us. CTV, which is the households, connected households, very important touch point for us. And we are closing the loop overall with a very small but an important use case, which is to say that the brands also want to drive conversions on their physical store. So, digital out of home is also another area that we would look at. But I would say it would suffice to say that over 90% focus is on in-app mobile and CTV at this moment, and a very, very small percentage would focus on digital out of home.
Understood. And if I can take one more.
I'm sorry to interrupt. Mr. Gus, please rejoin the queue for more questions.
Okay, sure. Thanks.
Thank you. Next question is from the line of Hardik Goyal from Union Mutual Fund. Please go ahead.
Hello. Thanks for the opportunity, sir. Sir, just one question from my end. Given the current geopolitical situation and some signs of recessions coming in, are we seeing the global brands are tightening their marketing budget? And how can we see its impact on Affle per se? Are brands shifting from general branding towards a higher ROI model of CPCU? Thank you, sir. Just
Thanks, Hardik, for the question. I have been leading Affle for 21 years, and we have seen several financial crises, crises in the journey of 21 years. And I've been an entrepreneur for more than 30, so I've, seen, a fair bit of that. We have built Affle's business model for resilience and for fundamental, deeply integrated modes with the customer and aligning our, entire existence with the, for the benefit of the customer. I think this kind of alignment is very dependable, very trustable, and especially when times get tough, it becomes very important. So when times get tough, as they are, and have many times in the past, we are of the clear view that the CPCU business model is going to be resilient, is in fact going to be the go-to business model for the advertisers, because the businesses when recession happens, it's not that businesses stop. Businesses find it harder to make revenue. And in that time, they want to spend their advertising dollar with great prudence and careful measures to say that if I'm spending this ad money, I better get ROI. I think it is common sense, but we have seen it repeated number of times that all budgets get tighter. And when budgets get tighter, when the going gets tough for everyone, only the tough really can get going. And this business model is a resilient business model. It is a tough business model. And I think we have anchored ourselves on it for this very reason. And when we were going public in 2018, 2019, and I was on the road shows, people were asking, are you sure, you're ready to go public? I said, yes, I think this business model I can deliver to the public market investors a resilient, dependable, and durable, long-lasting, success pattern. Last quarter was a tough quarter geopolitically, right? Jan, Feb, March 2026 was a tough quarter. And it was a quarter without the benefit of festive seasonality. Typically in advertising businesses anywhere in the world, you will find that their highest quarter is October, November, December. Because of Diwali, because of Christmas, school holidays and shopping. Without the advantage or the tailwinds of the festive quarter, with the headwinds of geopolitical issues, Jan, Feb, March, was very resilient for us. We were able to grow at least the top line better than, and even a bit better than the last quarter. I mean, in terms of fundamental performance, CPCU business in a very small snapshot of the last quarter has already shown you resilience. I think if I was an advertiser and the economy was in a tough place, I would gravitate to CPCU business model much faster than they are otherwise doing.
Thank you, sir, and all the best for the future.
Thank you. A reminder to all the participants,